Abbvie stock, ticker symbol ABBV. This stock is up 6% year to date, while the S&P 500 is down roughly 14% year to date. So that's quite interesting to begin with. But when Abbvie released the earnings this Friday, the stock went down roughly 10%, which is quite a lot. So what happened, and does this small dip mean that Abbvie stock is a buy? In this video I'm going to check real quickly the earnings and show you what Abbvie does. A view at the historical returns, the fundamental analysis, dividends, their major competitors, and in the last part I'm giving you my price target to see if Abbvie stock is a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Abbvie do? In a nutshell, Abbvie is a pharmaceutical company with a strong exposure to immunology and oncology. The firm's top drug, Humira, represents close to half of the company's current profits. The recent acquisition of Allergan adds several new drugs in aesthetics and women's health. When we check the earnings, we see that Abbvie beats the EPS normalized by a small margin, but missed the EPS gap big time. Revenue is also a small miss, but in my opinion it's just small, so it's not a big deal to me. So why did shares fall down 10%? Well, investors and analysts are afraid that the top drug, Humira, will face big competition next year, with the first expected competitor to go on sale in late January. Analysts expect that Humira sales are going to drop to around 12.7 billion from 21 billion this year, which is a big drop to be honest, and of course this concerns me as well. But only time will tell us what is going to happen, so be prepared. But we can check other revenue drivers as well, to see if they can boost the revenue in case Humira will drop in revenue. First of all, let's check the overall revenue breakdown. In total, we have 6 key revenue segments: immunology, oncology, aesthetics, neuroscience, eye care and other. When we check the geolocation, revenue is broken down into the US and international, where US represents 78% of the total revenue and international only 22%. It's quite obvious that the top drug is Humira, representing a total of 36% of the total revenue. So when this is going to drop roughly 40 to 50% in revenue in next year, we might have a big issue. But there are some other drugs growing big time, which may save the overall revenue in the future. A thing that really catch my eye is the fact that Humira is down 13.8% international year over year, while the US is up 9.6%. In total, Humira is up 5.8% combined. And the thing that I really liked is the fact that both Skyrizi and Rinvoq are growing big time. Skyrizi is up 85% year over year and Rinvoq is up 56% year over year. And to me this looks very good and could also boost the revenue if Humira sales are going down next year. So this comforts me a lot. And with all the other drugs representing only a small portion of the total revenue, we see some growth, but also some drugs are decreasing in revenue. All drugs combined, the revenue is still up 5.6% in the US and only 0.6% international. Total combined, we have a 4.5% increase year over year, so it doesn't look that bad in my opinion. The last thing that I want to highlight is the fact that Abbvie reported spending 2.2 billion on litigation matters in the second quarter, which is sad, primarily includes a charge related to the potential settlement of litigation involving Allergan's past sales of opioid products. And now that we know what happened with the earnings, it's time to check the historical stock price performance to see what happened there. I decided to include the S&P 500 as a benchmark, and also Amgen and Gilead Science, which are both competitors of Abbvie. On the 5-year chart we see that Abbvie had by far the highest return with 166%. But this is mainly caused by the big run late 2021. We see that the orange line went up big time. The S&P 500 had a total return of 82% in the past 5 years, including dividends. Amgen a 64% return and Gilead a minus 5% return. So only Abbvie did beat the S&P 500 and also by quite a margin. On the 1-year chart we see that Abbvie had a 25% return, while the S&P 500 had a 33% return. Amgen a 5% return and Gilead a minus 10% return. So the S&P 500 did better than all stocks, but Abbvie is really close. On the 6-month chart, we see that Abbvie had a total return of almost 6%, while the S&P 500 returned a minus 6%. Amgen is at 10% and Gilead is at minus 11%. On the 1-month chart, we see that Abbvie returned a minus 6%, while the S&P 500 did a 8% return. Amgen is nearly flat and Gilead had a minus 3% return. So does this mean that Abbvie is still a buy? Let's find out by checking the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. I also want to mention that I'm almost at 1000 subscribers, so help me achieving this huge milestone by giving me a subscribe. In return, you will receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Abbvie is a 254 billion market cap company, which makes them one of the biggest health companies in the US. PE ratio is at 20, which could indicate that Abbvie is around the fair value. In the last part of this video, I will give you my 3 price targets, so make sure to watch until the end. Abbvie has a 12 trailing month revenue of 56 billion, and in this graph we see that revenue went up quite nice and steady, so definitely like this part of the business. And keep in mind that the big increase in revenue is also related to the pandemic. Net income is at 12.4 billion, which gives us a profit margin of 22%. And I really like this part, since the current profit margin is significantly higher than the 5-year average of 18.6%. So margins are increasing, and this is something that I really like. Another thing that I really like about Abbvie is the fact that they really know how to invest their money. All numbers are above the 10% minimum, and the most important number here, return on invested capital, is at 19%, which is really high. And I think it's a great thing that it's significantly higher than the 5-year average, which is at 13%, so this comforts me a lot. But there are also some things that I really don't like about Abbvie. Right now, total cash is at 7.5 billion, but total debt is at 73 billion, meaning they have a lot of debt compared to the free cash flow, and this is something that worries me a little bit. In my opinion, we need to see some progress here in the coming quarters or years. I want debt at lower levels. I prefer companies who can pay down at least 50% of their total debt. So for me, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, do acquisitions, research and development, and of course dividends. When we check the free cash flow growth over the past years, it looks really good to me. It's growing in a steady and consistent pattern, which is something that I really like. So debt may be too high right now, but free cash flow is doing very well. And this is also much needed, because it's used to buy back shares as well, but also pay dividends. Let's start with checking the shares outstanding. You want big companies like Abbvie to buy back shares. This creates a lot of value to the investors, since your piece of the pie becomes bigger. Next to that, it's more easier to maintain and increase the dividends of course. But when we check shares outstanding, we see that Abbvie issued a lot of new shares during the pandemic period. In the latest quarters, we see that things are cooling down. And hopefully they will start to buy back shares very soon, since I don't like it when companies issue new shares. And now the part that people laugh about Abbvie, the dividends. Abbvie pays a juicy 3.93% dividend yield, so let's call it a 4% dividend yield. And this is very high. And it's also at a very healthy level, since payout ratio is at only 20%, and they grew the dividends for 9 years in a row. On top of that, they have a 5-year compound annual growth rate of 70.4%, which is also very high and one of the reasons why people love Abbvie. And now that we know more about the fundamentals and dividends of Abbvie, it's time to check the competitors and compare them to Abbvie. I decided to include Amgen and Gilead. We see that Abbvie is by far the biggest company in terms of market cap and employees. Both Abbvie and Gilead are trading for much lower PE ratio than Amgen, so that's quite interesting. When we check revenue growth, we see that Abbvie has by far the highest 5-year revenue compound annual growth rate, and also the highest net income compound annual growth rate, and free cash flow compound annual growth rate. So to me, Abbvie is the big winner here. Another thing that I really like is the fact that Abbvie has the highest net income margin, the highest free cash flow margin, and the highest return on total capital. Unfortunately, in this graph we see 12.9% for Abbvie, but it should be 19% as we saw earlier. When we check the balance sheet, we see that all companies have a lot of debt and don't have enough cash to pay down a big chunk of the total debt. But if we need to pick a winner, it will be Gilead. The last part will be about the dividends. Gilead has the highest dividend yield, but Abbvie has by far the lowest payout ratio, which gives them a big lead when it comes down to investing free cash flow in other parts of the business. Next to that, Abbvie has the highest dividend compound annual growth rate, which is also very important. So although Gilead has the highest dividend yield, I think I will choose Abbvie all day when it comes down to dividends. And now that we know everything about Abbvie that we should know to come up with 3 price targets, it's time to fill in a low, mid and high assumption to see if Abbvie is a buy. I'm using the Everything Money software, which is one of the best tools out there. Definitely check them out. So we need to fill in a few key numbers, starting off with the revenue growth. I expect revenue to slow down a bit, because of the Humira issue of course, which they will face in the coming years. But we also see that other drugs are growing big time, so I think they are still capable of growing the business. I'm aiming for a 9% growth in the low assumption, 10% growth in the mid assumption and 11% growth in the high assumption. With profit margin I'm going for 18.5, 19.5 and 20.5. Which are all lower than the current profit margin. I expect that the top drug Humira might cause some problems. Free cash flow margin is really high and I'm also aiming a bit lower, with 30, 31.5 and 33%. PE ratio and price to free cash flow is a bit difficult, since I think Abbvie is a great company and also with some moat in their drugs. But it's also a big company, which may face some problems with growing in high amounts, so I'm filling in 14, 15 and 16. For the annual return I'm aiming for 12.5%, since I can get an easy 10% return with owning an ETF in the long run. Right now Abbvie is at $143 a share. I hit analyze and we see a lot of green numbers here. A low price target of $110 to $178, a mid price target of $129 to $209, and a high price target of $152 to $245. And this is also influenced by the high free cash flow margin, so that's why we see a big range. I think I will aim for the mid price target range, which will be around $129 to $209 a share. So this means Abbvie could be a buy if you believe these numbers. My final conclusion on Abbvie is that I really like the business and I like the stock as well. But Abbvie might face some problems with their top drug Humira, and you can't ignore this. But when we see the potential of the other top drugs are growing 50 to 85% year over year, I feel very comfortable. But still, you need to pay attention to what's happening with Humira. The things I like about Abbvie is the return on invested capital, revenue growth and also the dividends of course. But I don't like the debt and shares outstanding, so this is something to keep in mind. For now I think I will increase my position in Abbvie in the coming months. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.